So very good evening to all of you. So I'm sorry for the delays. Technical problem has caused the thing. So thank the outset the Mumbai Chamber of Commerce for having given me this opportunity to make a presentation among yourself. So before we go in detail about discuss about what are the risks, a brief of what ECGC is, the company that I am representing. See, ECGC was set up in the year 1956. We are a 100% owned company working under the administrative control of Ministry of Commerce and Industry. So we are governed by board of directors consisting the representatives from the Ministry of Finance, Ministry of Commerce, Government of India, from the Reserve Bank of India, from the banking industry, the exporting fraternity. So we are also regulated by the IRDAI, which is the regulator for the insurance business in India. So we were the pioneers in the export credit risk insurance in India. So when we see why any exporter or an insured go for an credit insurance. So credit insurance protects the exporter from the risk of non-payment. A credit insurance is unique from the normal general insurance or a life insurance. Here, this is an insurance which will protect the insured from the non-payment of his overseas buyer. The ECGC exclusively deals with the export credit only. So we don't offer insurance cover for the domestic credit business. So if a customer is going to avail credit insurance, his balance sheet is well protected against the, his balance sheet will not be affected by the non-payments of his buyers. It also strengthens the credit assessment of the customer. See, there will be a double assessment of the buyer. One, due diligence done by the customer himself before he's assuming a risk on the buyer. The other is the assessment done by ECGC, which will be independent of the insured's assessment. So it will also help him in growth of his sales. Today, if someone has to improve his business, he will have to offer credit. A credit involves a risk, a higher risk. So by insuring himself, it gives him the confidence to expand his business without the fear of non-payment of his buyers. And it also enhances the credit management decision-making process through the offering third-party evaluation. And if a buyer protect credit, he can also have an ease in having his banking finance. So because apart from the collateral he submits, the credit insurance offered by ECGC is equivalent to a cash collateral to the lenders. So if a person is availing an credit insurance, he can have a peaceful sleep, a hassle-free one, because it gives him a self-confidence that if his buyer is going to fail, there is an institution which is going to back him in his time of need. So risk in case of an export activity can be due to the uncertainty about the outcome, the lack of knowledge about his customer, and also the imperfection in the knowledge. The lack of knowledge is a far better one than the imperfection in knowledge. And there is the possibility of a loss. So what we say lack of knowledge is, see, when you do an export, all Incoterms, everything in place, each country has got its own, special characters. Now, for instance, if we take the case of a developed nation, it talks about so much of transparency. If there is a default, the country says that you can sue me for the losses. But the problem in a developed country is the cost of litigation. A customer cannot afford to. If he has to recover $100 from a overseas buyer from a developed country, he will have to incur at least $1,000 to get his debt recovered. So, when this is in the case of a developed country. In case of Middle East nations, kingdoms, those countries does not allow a foreigner to sue their citizen. So there, if we are facing with a default, we don't have any scope for recovery. Later, we come to countries like African nations. In African nations, everything is there, but nothing is there. See, there, the system says that I've got so much of facilities available, but nothing can be utilized. There will be a high amount of corruption, and if you visit that country, there is no guarantee that you may come back safe. Then we will, apart from our loss, we will have to pay some ransom to come back alive. So this is the complexity of an international trade. And the whole of the world doesn't speak English. Each country has its own languages, its own internal. See, the jurisdiction in case of a default will be resting in the buyer's country. So language will be an issue. The law in the local country will be an issue. The cost of litigation will be an issue. Above all, the safety of the citizens, the exporter, if he visits the country, that also becomes an issue. So this is the complexity and export trade, throws up. So normally in case of an export transaction, madam, you can go to the next slide. Normally in case of an export transaction, we can classify the risk broadly into 5 categories. The next slide, madam. One is the political risk. A political risk basically is the risk associated to the importing country. That could be a war, civil war, internal disturbances in the country. There could be a coup in the country, or anything, whichever thing which is which is related to the government in that country. The second risk is credit risk. Credit risk basically is a risk related to the importer. The buyer's failure to make payment due to insolvency, due to default, due to repudiation risk, where the goods have reached the destination, the buyer is not taking delivery. These risks are basically risk related to the importer. His acts of omissions and commissions, which is resulting in a non-payment situation. The third risk, which is the exchange risk, which is common in the underdeveloped nations, where the buyer is having enough money to pay, but the country is not having. The exchange is basically, see, when there is a high fluctuation in the currency. See, when we dealt an order at that point of time, the local currency's rate, besides the USD, was say 80 rupees for $1. But by the time the payment was due, the dollar rate has depreciated and it has become 100 now. Now the buyer feels the difficulty in paying. So normally, in a short-term credit, there is an option for the exporter to hedge his exchange rates, or normally it is called as a forward contract. If he does that, he can protect himself from that risk. The next risk, which is a transfer risk or transfer delay. This is where the buyer has paid the money to his bank, but the central bank in that country is not having enough foreign exchange to transfer. So this is morely common in the underdeveloped countries, mostly in the African nation and few Asian countries, where this kind of risk is seen. The last one is the legal risk, where if there is an element of non-payment, then what is the legal recourse that is available to the customer, and it comes with what amount of cost, whether it can be afforded by the exporter. That is another major risk. Madam, we'll move to the next slide. So we will just elaborate. These are the risks which ECGC covers in case of a commercial risk. The first and foremost is insolvency of the buyer. When we say insolvency, as a layman, we think the insolvency will be very common in the poor nations. But the fact is, insolvency is a very common risk in the developed nations, and USA is the topper in this. In USA, there is chapter 7 to 11. Under this chapter, The buyer can invoke himself insolvent, and once a company becomes insolvent, then the exporters basically will be categorized as an unsecured creditors, and he will only, if at all, he is normally does anything once the company goes insolvent, or if at all he gets, sorry, just a minute. If at all he gets anything, sorry, just a moment. Yeah, if at all he gets anything, he'll be getting a peanut. If against $1, he may get 1 cent or 2 cents. And this insolvency is very, very common risk in almost all the developed nations. The next reason for a non-payment is default. Default or willful default. This will happen in case of a credit terms, where we give an usance period to the importer, ranging from 30 days, 60 days, 90 days, depending upon the contract. And the importer is expected to pay on the maturity of the bill. If it doesn't pay, it is called willful default. And in such a situation, the exporter ends up in a 100% loss. So in that situation, ECGC covers him to the extent of 80 to 90%, because we operate the credit insurance on a principle of co-insurance, which means certain percent of risk will have to be borne by the insured. The maximum cover that we offer is 95%. That is for a small exporter who is having a turnover of less than 5 crore per annum. For all other exporters, it is ranging between 80 to 90%, depending upon the kind of insurance cover they have chosen. The third, fraud. For fraud, there can be no insurance at all. The third is a fraud. Insurance, you may know, is for an eventuality. It cannot be for a fraudulent transaction, but fraud also happens. Fraud basically, what happens is the importer impersonates himself as some other leading importer in that country, and he imports the goods. When we offer a cover, based on the name that is appearing in the order. So if it happens that later that person has what you call impersonated, or sometimes what happens is the goods reaches the destination, he takes the delivery by fraudulent means, which is violative of the import term. See, normally the shipping companies are expected to release the goods against presentation of the original document. If suppose the goods have been released without the presentation of original document, which basically involves a collision between the shipping company and the importer. So we don't cover the risk of the failure of the agent. So fraudulent activities will not be insured. The fourth risk, which is a very, very common risk, is unwillingness to accept the goods on the part of the buyer. Technically, we call that risk as a repudiation risk or a non-acceptance risk, but the goods have reached the destination, but the buyer is not picking up the goods. So in a situation, what will be the loss? See, normally we say this is very common in case of an DP terms, which is document against payment, or otherwise called as cash against document, which means the exporter sends the documents to his bank. From his bank, the documents are consigned to the buyer's bank. The buyer is expected to pay the invoice in full. Then only he will get the documents in his hand. Then he will go and take delivery. Here, what happens? The goods have reached his bank, but he is not willing to take the goods. It could happen he has got into a financial difficulty, or there is a change of fashion, or there is a rate fluctuation, or it could be any reason. But the fact is he has not taken delivery of the goods. In such a situation, the loss that will be is, see, if the goods are not accepted, there are three options available to the exporter. The first and foremost is to resell the goods to an alternate buyer within the same country or an alternate country. And another universal truth is, whenever we are in difficulty, even our good friend, our close relative also will like to always make best use of our difficult times. In such a situation, we will have to offer a discount the alternate buyer will not take the goods at the same price. So here the loss would be the discount that is offered to the alternate buyer. In the meantime, since the goods are lying in the port, it will also incur damage cost. That is another loss. So when the goods are sold to an alternate buyer, the discount plus the damage cost incurred will be the first loss. The second option available to the exporter is to bring back the goods to his country. He feels that he's not getting an alternate buyer. He feels it's better I bring back the goods to my country and sell it locally. That will, in that way, I can salvage my loss in a better way. If he decides to re-import the goods, in such a situation, ECGC will compensate the exporter for the to and fro freight charges, the damage costs that he has incurred in that country, and the customs and handling charges in both the ports. This will be compensated to the exporter. The last option available in case of a repudiation risk is abandoning the goods. Now, abandonment means incurring a total loss. So in such a situation, we will expect the customer to convince us why he could not resell. Now, the common reasons for abandoning would be one: it was a perishable goods, so it has lost its shelf life. So there is no point in bringing back the goods. So he decides to discard the goods in that country itself, because there is no point in re-importing goods which doesn't have a shelf life. The other thing is where the what you call commodity exported by him was a tailor-made, which means it was specifically designed or developed for a particular use of his customer. And if that person doesn't lift, then it is of no use to anyone else. In that situation also, the customer will have to abandon the goods there. So if you have to abandon, you will have to take a prior approval, and accordingly, once the approval is given, we will cover the whole risk. So these are the risks that we cover under the commercial part. The next risk that we will discuss is the risk involving the country of import, political risk. The political risk, some of the countries may experience major political instability, the balance of payment problem, exchange transfer blockages, nationalization, confiscation of properties. So these are a common political risk. Balance of payment problem is basically the country is not having enough foreign exchange to repatriate to the country of export. This is a common risk in case of countries where their economic condition is very poor. Now, recently we are hearing something about Sri Lanka. Sri Lanka is also facing a severe foreign exchange crisis. The other, almost all the underdeveloped nations, we have this problem. Most of the African nations have this problem. The exchange transfer blockages are basically where an UN sanction is imposed, or US is imposing a sanction on that country. In such a situation, no US dollar transaction will be permitted. In the current years, the common example is Iran. Now, Iran, there is a sanction imposed by US as well as UN, because of which the commonly traded currencies like Euro and USD is not permitted. So any transaction involving USD for Iran, immediately the banks will block this. So here the situation is the buyer is making the payment, but because of the sanction imposed in that country, the money we are not able to receive the money in our account. This is another political risk. Other one is nationalization. See, the importer in that country, all of a sudden the country decides to nationalize certain section of industries. So once the nationalization happens, so whatever the credit commitments made by the existing owners will be totally gone. So we will not get to receive anything because the government has taken over. So it will only depend whether the government is willing to honor its past defaults, or it wants to say that whatever has gone has gone. Now any new transaction only I am going to I will give my commitment. This also we will face in case of a kingdoms, or in case of where there is repeated coups. In such countries, we'll say face this kind of problem. Confiscation of property also more or less similar to to the national conflict. See, when one fine day, the government in that country decides that what all goods lying in the port are nationalized, or all these goods have been confiscated. In such a situation, the importer, since he has not received the goods, he is not going to pay. So this political risk, basically a risk which is beyond the control of the importer and the exporter. It is a risk which is straightly associated to the country of import. The next risk we'll see in detail is exchange risk. Exchange risk is basically the possibility of variability in the exchange rate on account of time lag between the date of contract and actual payment. This will be very common in case of a credit term. As you all are aware that exchange rates keep fluctuating daily. It depends upon various factors, various international factors. If there is a bomb, a nuclear test conducted in Iran, it immediately reflects across the nation. If there is a crisis in China, the whole world gets shakes up. One single event, even Omicron issue, that also can trigger an exchange rate fluctuation. Any market panic, anything that shakes the international market will directly impact the exchanges. So normally, in case of a short-term credit in India, they have the option of going for an forward contract, wherein the exporter will, depending upon the prevailing currency rates, they will take a forward contract with the bank to protect them from the adverse fluctuations. See, here the risk is, let us assume today the rupee rate is 75 per US dollar. So he is saying that he will protect himself at $76, which means if the dollar rate falls below 76 also, the bank will pay him at 76. But the risk here is, if suppose rupee appreciates and the dollar rate has gone to 80, you will not get the benefit of the increase of the US dollar. So it is basically another type of insurance where he cannot make profit of by going for a forward contract, but he can protect himself for the adverse fluctuations. So his costing, he can base it based on his the forward contract rate he has booked, and he can be rest assured that however low the rates may fall, he will get an guaranteed rate of exchange. That is the advantage of having a forward contract. And exchange risk we don't cover under our under short-term policy, but we cover this kind of risk in the insurance cover that we offer to the project exports. Project exports involves deferred payments involving range between 1 year to 5 year, 10 year, 15 year. Where in such a situation, we cover for the exchange risk. For short-term credit is basically payment up to 360 days. For that period, we don't offer a cover under our policy for the risk of exchange fluctuations. Now, transfer risk. Transfer is basically a risk weakness in economy of the buyer's country with low reserves, balance of payment problems, or exchange or trade controls introduced in the buyer's country, or failures of the buyer's bank in affecting the payment of outstanding. This risk basically it's related to the foreign exchange availability with the central bank in that country. If the central bank in that country does not have enough foreign exchange, then what they do is they will prioritize the exchange. If suppose the country has got very limited resources, they will say that the foreign exchange can be used only for medicine and food items. They will not allow this foreign exchange to be utilized for any other commercial activity. So here it could be a case of a temporary issue, or it can be long-term also. That depends on the country's economic situation, or the government prevailing there, if they are able to negotiate any deals with the IMF or the World Bank, wherein they will agree to certain certain conditions imposed by them, certain disciplines to be introduced. The government spendings will have to be curtailed on their welfare schemes. If they are agreeing to commit on those things, these World Bank may infuse funds, but that all these things comes with a price. So they will have to liberalize their economy. They will have to allow the foreign investors to start their company. They will have to give a lot of shops to them. If they are willing to do, maybe they will, allow. They will lend some foreign exchange to them. So this is mostly in case of a poor countries, we will have this problem. The legal risk is differences in law which can be expected in overseas countries. This may have an impact in some areas such as import procedures, the taxation, the employment practices, currency dealings, property rights, the protection of intellectual property, agency distributionship arrangement. So these are all, when we had negotiated a contract, there were certain laws in place. By the time the goods are in transit or the goods have reached the destination, there are changes in the import procedures there. They are introducing a new standard which has to be complied. Now, these things are beyond the control of the exporter as well as the importer. A situation may come, the goods may not be allowed to be embarked in that country, or a situation will come that he will not be allowed to sell the product because of a new law introduced there. This kind of risks are very common in case of food products, in case of pharma related product. Even sometimes we face this situation in India for carpet exports. See, carpet exports, carpet manufacturing involves a lot of what you call child labor. So all of a sudden, the importing countries introduced a standard, introduced a license, stating that if the company has to export, they should have a license, which means that no child labor was used. So if these things, when they change immediately, all of a sudden, that will impact the exporter in a very big way. And this legal risk, see, we at ECGC, what we say is, if at the time of their shipment, there were certain rules which had permitted certain things to happen, but after the shipments were effected, when the goods have reached the destination, or it is in the transit, that time around, the government has changed their import policy, because of which the goods are not allowed to be embarked in the country, are not allowed to be sold in the country. Such situation we cover. But if the rules were already in place, the exporter was not aware of that, then such situations we will not step in. So export credit insurance basically it says in case of a default is basically inability of the buyer to pay, or is willful, he's not having an intention to pay. So that risk is insured. Insolvency, I had explained, it is the buyer there goes bankrupt. In such a situation, we end up in a complete loss. That risk is very well insured with ECGC. The repudiation, I explained to you, it is a risk of non-acceptance. In case of a non-acceptance, I told we can either resell, re-import, or abandon. All the situations ECGC covers. And there are two risks related to the LC opening bank. So you people will be aware what is a LC transaction is. So LC is basically a banker. When we don't have a confidence on the importer, we say that we want to have a better protection when we have to deal with you. In such a situation, we have a terms of payment called LC transaction, where the LC opening bank will take the responsibility for payment, provided the terms of LCs are compliant. So here the emphasis is on the document. So on the LC bank itself goes insolvent, which is not common. We have seen this happening time and again. So if an opening bank has gone insolvent, that insurance, that loss is issued with ECGC. If he has taken an LC protection against the opening bank, we will honor the claim. The default of LC opening, what I mean is, you will be aware in case of an LC transaction, once the document is received at the opening bank will have to raise discrepancy, if any, within 5 working days. This is as per UCP term. If the bank has not raised any discrepancy within 5 working days, the bank is obliged to honor the bill. But sometimes it happens that in spite of no discrepancy being raised, the opening bank defaults. This could be a financial difficulty of the opening bank or for any reason for it. So if there are no discrepancy and the bank has accepted the bill of exchange, so the bank has accepted the LCE document, but they have not paid in time, or they have not honored the bill, then ECGC will give protection if the exporter has availed the LC cover with us. This is a snapshot of what are the political risks. The first is the war risk that we discussed. War or other armed conflicts. It can be revolutions or civil distribution, civil disturbances or terror acts. So recently we had seen that there has been a coup in Sudan. So there is a change of government now. And in Asian countries also, we see this as a very common risk. Time and again, we have seen in our neighbor country, Pakistan, there has been a lot of coups. Many times the army takes over the government. So in such a situation, their commercial commitments are being dishonored. So that risk is covered. Diversion of voyage. Diversion of voyage, I'd like to explain what happens. See, normally the goods, if it is to travel from India to US, it goes through a specific route. If there are any disturbances in the route, if there any war has happened or any natural calamities, then the goods have to take, the ship has to take a different route. When it takes a different route, it involves additional cost, also additional time. So if the buyer refuses to accept for the delay or the additional flight charges incurred, covered with the ECGC insurance. Transfer delay risk, this also we cover. Here what it is, we will have to get a proof that the buyer has made the payment and that country is not having foreign exchange to repatriate, then it will be treated as a political risk and we will pay claim to the exporter. And restriction imposed by the government or other entities directed or controlled. We discussed this. I told the situation of Iran. So Iran is a cash-rich country, but because of the sanctions imposed on them, there are, what you call payment issues. The last one is nationalization or expropriation or sovereign acts, which in their acts are equivalent to expropriation. This basically the country, the importing country nationalizes. Suppose you have exported certain goods to a country. If that country nationalizes those businesses in that country, then all the payment commitments also will be passing out to the government. That being a sovereign government, they may even declare that they will not pay. Most of the time they don't pay. This also happens in case of underdeveloped countries where military coups happen. In those countries, this risk is very common. So the covers that we offer, I don't know how much it will be relevant to my overseas viewers who are listening. See, with ECGC, what we do is we offer cover under 3 categories. One is the declaration-based cover. A declaration-based cover, basically, the premium is on each shipment that is affected by the exporter. So it can be whole turnover. Whole turnover means the exporter is dealing with 10 buyers, dealing with 20 countries. All the business that he covered with us, or he can have an hold on a particular buyer, or he can go for a specific only for one shipment or one contract. So that discussing about what is the kinds of cover that we are offering. And brief you about the declaration-based cover. In case of the exposure-based cover, the exporter can take a policy for the exposure that he wants. He determines that my outstanding with the buyer, or I will be comfortable for X amount of insurance. You offer me that, we will be doing that for the customer. The other one is specialized, is where you can take for the what you call software exports, IT enabled services. You can avail a cover. These are the types of covers that is, see, this will be relevant to you only if you are, in India. So I will just skip this slide. So how we underwrite the risk? See, we have got a centralized department called buyer underwriting department, which will analyze each of the buyer based on their business ability, their financial strength, their transaction behavior, and the industry that they are dealing with. This is a centralized department. This will decide whether the risk can be assumed on a particular buyer or not. If it is to be assumed, to what extent we can do. So our coverage will depend upon the decisions given by our buyer underwriting department. And we also have another department which is called the country underwriting department, which will be constantly studying the status of the countries, their political situation, their financial position. So we have rated the countries into 7 groups, A1, A2, B1, B2, C1, C2, and D. So our cost of insurance will depend upon the country rating and the terms of payment they deal with. If they deal with the safest country with the safest terms of payment, the premium will be the least. So accordingly, the premium rate will go higher the risk, higher will be the premium. Right. And so we also offer covers to banks in similar line to enable them to have hassle-free lending to the exporters. So we basically protect the banks against the non-payment risk of the exporter who avail finance with them. For this, the bank has got an option to have a whole loan cover or an individual cover. So this again, since it is a risk related to the institution, I will not, deliberate much on this. I just have given an overview. See, we as an institution who is having the responsibility of promoting exports in India, we also facilitate the exports to avail easy finance by way of the insurance that we offer to the bank, so that the bank can have more leverage in extending credit to the exporters. So these are things. These are all our financial results, which again,